Hey everyone, welcome and welcome back to my channel once again. This is your friend Abhishek, but not a financial advisor like always, and it's been a long time since I recorded any long form video, but the reason was that I had other opportunities and other priorities in my life, and I had been making short form content as well. And to be honest, I was a bit demotivated to record videos because I saw that many of my videos did not get as much as views like I expected, even though I put a lot of efforts. And I realized that many of the viewers who came onto my channel was coming just because of Cassava Sciences. And even though when I mentioned that a lot of times that my channel is not just based on Cassava Sciences, and somehow it didn't reach out to many of you guys, but still I have some loyal viewers, and that's the reason why I'm recording this video. And for the others who just came on for Cassava Sciences, I appreciate you guys as well, but if you don't want to listen to all this what I'm saying or mentioning, you can easily unsubscribe, or please feel free to not watch these videos instead of commenting some bullshit stuff, because I'm not here to earn money, to be honest, from you guys. I have no intention, I never had any intention to earn from YouTube, and that's why I was coming here whenever I wanted, whenever I felt, and whenever I got some requests from my viewers that they would like to know some information on some particular stocks. That was the reason. That has been and had been the reason since I started my YouTube journey. Anyways, so I'm back anyways, and I would like to mention that I am thankful to you guys, and I'm aiming for 15k subs. Let's see if we can reach there, but if not, then also not a problem. I would really appreciate if you guys would give a thumbs up to the video and subscribe to the channel. So not wasting your time, coming back on track. So today's video is about 2 high growth stocks which we are buying for the year 2025, me and my Patreons. So we did buy these stocks in the past, but then we sold at a decent profit. But then again, the stocks seem to be quite undervalued, and that's why we started buying it again. And that's why I'm mentioning this to you guys, because they are still trading at a fair value, to be honest, or even undervalued. So the first stock which is in this list of high growth stocks to buy in 2025 is none other than Oscar Health. Now at the time of recording this video, Oscar Health is trading at $15.41. So we started buying it below $15. Like I said, we did buy it at $12 or $13 as well, but then we sold it at $20 because we thought it's a bit overvalued, especially regarding the news, which I will come on to in a moment. And but then of course all the news is still valid and there has been no changes. So we are still actually buying now at $15.40. So today we also bought, by the way, I'm recording this video on 15th of July. So today it's at $15.40. So this is a mid-cap stock, and the market cap is currently trading at almost $4 billion, and the P ratio is 38. So our target was to buy at 30 PE or 35 PE, but not more than that. But like I said, I still feel that it might be a bit undervalued. The reason why Oscar Health dropped so much, and more healthcare service providers or companies which provide Medicaid healthcare services like United Health, of course, CNC, Centene Corporation, Clover Health, and Molina, etc., they also dropped, because one reason was, of course, the Senate bill. The Senate bill is a pain in the ass, to be honest. It has created a lot of uncertainty for these service providers, so much uncertainty that Centene Corporation even pulled back its yearly guidance, and that was the reason when it fell by more than 30 to 40%, and it took all other healthcare companies with it, Oscar Health as well, and that was the time when we started buying it. Actually, United Health Corporation was under our radar. We have been buying this. So actually the second stock in the list is United Health Corporation, just disclosed it, but let me get on to that in a moment. So let's talk about Oscar Health. Now this is not a detailed video on any of these stocks. If you guys would like to have a detailed video, do let me know in the comment section. I will make a detailed video on these stocks. So Oscar Health dropped, and this was the reason, and then it dropped further because the analysts downgraded it further because based on these results. Now first, let's talk about the risk which is involved based on these healthcare providers. So let me go through this article which will explain us why this bill could really affect these Medicaid providers. So the headline says a lot. Trump spending bill will likely boost costs for insurers, shrinking Medicaid coverage. Okay, now let's see what actually it's about. So this explains the bill quite nicely. So President Donald Trump's spending bill is set to raise administrative costs and make managing costs more difficult for insurers. Yeah. like United Health, CVS Health, all the Medicaid providers. As a result, those insurers will likely pull back their Medicaid coverage and invest more in existing markets to retain their healthier members, experts said. And this is logical, right? If the bill is pushing them to raise the administrative cost, then to get more money or get more better margins or get more money from their customers, they would have to increase the prices for their services. This is what these companies are struggling with right now. States contract with insurers including United Health, CVS Health, Molina, Centene to operate Medicaid plans that are jointly funded by state and federal governments might get affected for sure. And the problem is that most of these companies, their business model is actually based on Medicaid services. Now, another pain is that the provision in Trump's One Big Beautiful Bill Act requires low-income adults in states that have expanded Medicaid coverage under the Affordable Care Act. So they are attracting more affordable consumers as well to prove every 6 months that they do meet the work requirements in order to maintain coverage. Now, this will create a more red tape kind of block for these healthcare providers, because the consumers, the customers would have to go through this painful Medicaid coverage process, and this could result in more difficulties. So these are the risks which these healthcare providers will face or might face in the future. So this is one of the risks which I wanted to talk about. But now let's talk about Oscar Health directly. Why I still believe that Oscar Health could be one of the good bets in this market to buy. So I will just talk about the financials because that is one of the most important things for me right now. And companies which have good financials can do wonders. Yeah. So the first thing first I would like to show you guys, which gives us a bit more confidence, is this is the slide which I'm showing right now. They reaffirmed their 2024 guidance, and this was in September, October. So they said the projection was that they will reach a total revenue of $8.3 to $8.4 billion. SG expenses would be around 20 to 21%, and adjusted EBITDA to be at between $125 to $175 million. And this is why I do believe in Oscar Health, because they have outperformed their own expectations. So this was the final result which they delivered. Total revenue was at $9.2 billion instead of 8.3 to 8.4, 57% year-over-year growth, 19% SG expenses. They expected more than 20%. So 500 basis points improvement there as well. Adjusted EBITDA, $199 million, which was supposed to be between $125 to $175 million. So, and net income, $25 million. So they have outperformed themselves. And this is why I do believe that they will continue to do so. Of course, like I said, there are a lot of headwinds coming in because of the bill and because of the consumer market right now. But if they increase their prices a bit more, then they would be able to achieve what they are aiming for. So, and they are targeting 20% revenue CAGR at 5% operating margin by 2027. Now, we do know that this might, of course, get affected because this was before the Senate bill was passed. But I do think that they still expected some of this. Consumer market was still the same. So they did expect that. And the EPS they expect in 2027 to be at $2.25. Now, even if we assume that, okay, 38 is quite high, let's say 20, and we take 2.5, which is the projected EPS, we get a price target of $50. Let's assume that they are trading at a PE of 10 like United Health, or 15 like United Health, and Centene is trading at 5, which is quite weird because they pull back their expectations, projections for the year. So this is what United Health did as well. But anyways, so even if we take 15 and we take 2.5 as the expected projected EPS, we still get a price target of $37, more than 100% upside potential, guys. So this is the reason why we are buying Oscar Health right now, because we think that this could give us a lot better opportunity, and it has more drivers, so multiple levers to drive sustained top line growth. So they have subsidy loss and enrollment shift, expanding their existing market presence, this is quite good because this will definitely help them to grow. And market and product evolution. So like I said, they are entering new markets with their ICHRA opportunity. ICHRA, now let me explain to you guys, is simple, and to put it in layman words, is that when you get the Mediclaim amount back from your employer, employer helps you in case of that. So basically what we have in Europe as well. So they are leveraging their cash position for more investment opportunities. So this is great. This is what we want to see, right? And this is quite important now. So their medical loss ratio, the target until 2027 is 80%. And how will they reach this? Disciplined pricing approach, balanced rate actions with growth and retention targets as we mature markets and expand. And this is what I mean that they have to do, especially in the current market situation. Medical cost savings, execute technology enable affordability initiatives, spanning core pillars of total cost and care, and scalability, of course. And since we are talking about ICHRA has the power to expand individual insurance beyond the traditional ACM markets. And this is impressive. So rising employer costs by 9%, growing distributed workforces by 24%. So they are working more people are working, more people get benefits. That means much better business for much better opportunities for companies like Oscar Health. And increasing stability of ACM market is around 21% CAGR, at a CAGR of until 2024. So the TAM is huge, guys. The TAM is huge, and this is what I wanted to cover with Oscar Health. That's the reason why we are buying Oscar Health. Now, the second high growth stock for the year 2025 belongs to the same industry, and that's United Health. Now, United Health had a lot of drama. We already know what happened with United Health. The CEO was shut down. The company had not been doing good. They also changed the CEO. When the CEO changed, they pulled back their guidance, and that's normal because maybe the new CEO had new plans, and this is what actually is happening. The new CEO said that they will revise their service charges and costs and everything. And with the new rising costs, which they could, because they have a huge database, they have a huge user base, which they could do. And currently the stock price is trading at $293, PE of just $12. I do believe that below $300 this stock is a steal, guys. United Health is a steal. United Health, UNH Corporation, is a steal below $300. And mark my words, in coming 5 to 6 years this stock will give 100% returns for sure. If not 100%, 70 to 8% for sure. Compound annual growth rate of 12 to 15%, beating the S&P 500 is quite achievable. So yeah, that's the basic of United Health. If you want a detailed video, let me know. I will make a detailed video on United Health as well. But those were the problems with United Health as well. Same, yeah. First, it has not been in good condition since the CEO was shut down. Then of course the new CEO was appointed, again left. The new CEO then came in, pulled back the guidance. The Senate bill came in, which is not good, doing good for the healthcare service providers, and the cost model which they would have to revise. So if we just take a quick look at its financials, we can see that in the trailing 12-month period, the total revenue as it's at all-time highs, guys. Yes, sitting at $410 billion, and the cash flow from operating activities, I would say it has been okayish. Yeah, it has not been steadily growing, but we know the reason why this is happening, but still in positive. So it's still growing at a CAGR of 12.2%, and the revenue is growing at a CAGR of 11%. And when a business is growing at 11% year over year with and having a P ratio of just 11 to 12, it doesn't make much sense in my personal opinion. So even if we say that EPS is growing with revenue, then we have a low EPS of $38, to be quite pessimistic. So if we take $38 as our EPS for the next 5 years, and we take just a P ratio of 15, okay, just 15. Trust me, guys, this was trading at 30 PE, but okay, let's take just 15. We get a price target of 570, which is almost 100% upside potential. But if we say that, okay, it can trade at 20, which is not that bad for a business growing at 12% year over year, we get a price target of more than $700. So I do think that this could be a huge opportunity as well. So we can see that the analysts are expecting for EPS to grow above 12 to 20%. So 20% 2026, and then 15%, then 37%, and then 12%. So this is my take on these two high growth stocks, guys. If you want, like I said, if you want the detailed video on each of them, then do let me know. I just wanted to give you guys a quick update what we are doing and why we are buying these stocks right now. So yeah, that's it, guys. That's all for this video. I'll see you in the next one. Until then, stay safe, stay healthy, and ciao.